Hello there, this is the Bookkeeping Master on YouTube, Part 8. Well done for making it this far. If you've joined the series here, go back and start from the beginning, because you'll get a lot more out of this video and this series if you obviously watch the whole series in the intended order. Okay, so tax and calculating tax. We all love a bit of tax, don't we? We love the tax man. The more tax, the better. A quick review before we go into the tax calculation. Before you do the tax calculation, all these things should have been done, and all these things have been covered in previous videos in this course. So this is part 8. The previous 7 parts covered these steps, doing all the bookkeeping, error checking, reconciling all of the accounts, and I cover this in more detail in those previous videos, the depreciation calculations and posting the depreciation to the accounts, same with accruals, prepayments, and also stock. The tax calculation is not too labor intensive. It should not take you too much time because all the groundwork is done in doing these things. The bookkeeping, the reconciliations take a lot of the time and energy, and all those previous adjustments, the depreciation accruals, prepayments, stock adjustments, all those things lead up to this point, and then after this point, they all have been done in order to create an accurate and detailed profit and loss statement and balance sheet. Okay. Any questions about any of these tasks, any of these steps, go back and watch the previous videos. Use the comment section below. I'm here to help you. The first thing to mention about the tax calculation is you need to seek the advice of a tax professional. This course is a universal course, and it is a course that teaches the basics. This course is not tax specific or business specific or even country specific. Every tax residency in the world has different tax rates, has different tax laws, and potentially has different tax calculations. So please seek the advice of a professional. I'm teaching you, like I said, the basics. It's very general. The tax calculation you'll need to do will be very similar to the one that I'm going to cover in this video, but you must seek the advice of a tax professional in your tax residency to ensure that it's done correctly. Okay, so that disclaimer is out of the way, let's have a look at a tax calculation. So most tax calculations are going to look something like this. There's going to be 4 parts to the calculation. There's the profit per the accounts, so that's the profit showing on the P&L after all these steps are done. So once all these steps are complete, we would run a profit and loss, which is much easier to do if you're using bookkeeping software or accounting software. With the profit per the accounts, it's not as simple as finding out the tax rate and then timesing that profit by that rate. So if the tax rate is 25%, you can't look at the P&L, say, well, we made 100 grand. It's a 25 grand tax bill. Some people think tax is calculated in that way. Perhaps for some of you in your country of residence, it is. But most of the time, it's not that simple. There is an actual tax calculation that needs to be done. And that is what we have here. The second line is the expenses. Now, this is not the expenses on the profit and loss. We're not reversing them, but what we are going to do is we're going to remove any disallowable expenses. We're actually going to add back disallowable expenses and increase that profit figure. So some countries, even though you have expenses showing on the profit and loss, some of them have to be removed for tax purposes. So here in the UK, there are a small group of disallowable expenses, and some of those expenses are things like client entertaining. So entertaining costs, they can show on the business accounts, they can show on the company profit and loss, but when it comes to the actual tax calculation, those expenses have to be removed, which increases the profit. And there are other disallowable expenses too, such as depreciation, fines and penalties, and things like that. The third line is tax incentives. Now, tax incentives are, as the name suggests, they are items that can reduce the tax bill. Now, generally, tax incentives, once again here in the UK, are things like asset purchases, and I believe it's the same in the US, in other parts of the world. So items that have been purchased in the year, assets that have been purchased, that are showing on the balance sheet, can actually be brought into this calculation and deducted against potential tax, or deducted against profit, which then brings down the tax bill. So tax incentives, here in the UK, they're called capital allowances, those asset purchases that can go against the tax bill. The last line here is the actual taxable profit. So the taxable profit is going to be different from the profit per the accounts. The taxable profit is the profit used against the tax rate, the tax percentage, not the profit as per the accounts. And let's have a look at this in a bit more detail. So the profit as per the accounts, that's after all these things are done. We add any disallowable expenses. There might not be any. There might be loads of them. We minus tax incentives. So that could be asset purchases. It could be other things. R&D costs like research and development. It all depends on the tax authority and what tax incentives they have in place. We then have the taxable profit, and that taxable profit is calculated against the tax rate to know how much tax should be paid. So here we have an example down here. So let's say the profit as per the accounts is 68,000. We add any disallowable expenses. In this example, let's say that's client entertaining, which is 3,000. So that actually brings our profit from 68,000 to 71,000. So 71,000 is higher than 68,000. So that profit figure has grown. We're potentially paying more tax. But then we minus any tax incentives. This could be asset purchases, say of 15,000, and that brings our taxable profit down to 56,000. It's this 56,000 that the tax is calculated, not the profit as per the accounts. So let's say the tax rate is 19%. 19% of 56,000 is 10,640. So once you have that figure, once you've done the calculation, we need this 10,640 to show in the financial accounts. And how do we do that? We use the trusted journal, that journal entry that has been mentioned in most of these videos. And the journal is debit tax expense. So in this case, 10,640. And that will go on the profit and loss. And we credit tax liability on the balance sheet. And generally that's a current liability, a short-term liability, because generally tax is due within 12 months of the financial year. Once again, it depends on your country of residence, your tax residency, but most cases it will be a current liability. And there we have it, the tax calculation. So all of the adjustments now are really done, apart from retained earnings, which we'll go through in the next video. But we're getting very close now to compiling that accurate, detailed profit and loss statement and balance sheet and drawing this series to an end. Thank you so much for getting this far. If it's been helpful, all I ask is for a like and a comment to say thank you. Check out my website. I'll speak to you in the next video.